The opinions and recommendations expressed by Dan are his own and do not necessarily represent the opinions of this station or any of the show's sponsors.
Welcome back. Financial Issues. I'm Dan Celia, 866-300-9298. We will get to the phones, right back to the phones, 866-300-9298. I was mentioning before that break, the dollar continues to lose ground against Japanese yen, of all things, who have done nothing but trash their dollar for the last 14 years. Had a increase in that dramatically last year, trying to get their stock market to increase, taking a page out of the Fed's book. Well, they took that page out of the Fed's book. We were calling it a currency war, if you remember, or possibly be in the beginning of a currency war. And they didn't like that much, but nevertheless, they did it. It worked. The markets went up 58%. They had a huge year last year in their markets. Now they've had a horrible year so far in the beginning of this year, and they're in a little bit of a panic. And yet, as their stocks continue to put out and release disappointing numbers, our dollar compared to the yen is going down. And I really have an issue with the fact that our dollar could go down against the yen. I mean, they only have about 220% of GDP, debt to GDP ratio, and our dollar is not keeping pace. What does that tell you? I don't want to think about what it's telling us. Anyway, 866-300-9298. Let me go to Kevin. Kevin calling us from Oklahoma. Good morning, Kevin.
Good morning. How are you doing today?
Good.
I sure appreciate what you're doing, Dan. It's good to hear you in the morning.
Thank you.
I had a quick comment. A few years ago, I don't know if Sallie Mae still does it or not, but a few years ago, I was able to consolidate my student loans. I had 2 student loans, and consolidating them dropped them down in, I think I had 9% interest at that point, and it dropped it down to about 7% interest. Unfortunately for me, if I had waited about 3 more months, it would have dropped down to 3%.
But you were able to consolidate those. And what did you do, Kevin? Did you go through Sallie Mae?
Yes,
You did.
called up Sallie Mae, and they informed me about this consolidation program, and just applied for the consolidation.
Well, hopefully our listener from Arkansas is hearing that. I'm glad you called in. Yeah, that's a shame. I mean, you can always say, well, 7's better than 9, but it still hurts, when you think of what you could have had there. But just keep plugging away, paying. How many more years you have left, Kevin?
Yeah, I'm hoping that the interest rates are still somewhat lower than 12%.
Oh yeah, they are. yeah, I think so. So you'll be okay in that regard, I think, for a little while. Thanks, Kevin. I appreciate the call. I know that's going to help our listener in Arkansas, so I appreciate that. Let me go to David in Ohio. Good morning, David.
Good morning. Thank you, Dan, for taking the call. I've got a sort of an interesting question, and I'm wondering for some research help.
Okay.
I heard of a stock that gained like 4% on Friday, and when I heard what it was, I thought, well, they've got pretty much a niche market. They're the only one doing this thing, and I cannot for the life of me remember what it was, and I'm wondering how I can research like 4% gainers on Friday.
I don't know. I wish I could help you, David. There was a whole bunch.
Maybe you would have a trick.
No, I never. There's probably some research out there that you can look at all gainers. I know you can do that. So you can look at winners and losers, and you can look at all the winners in the market on Friday. So you would have to look at the winners from the NASDAQ, from the S&P, or from the NASDAQ, from the S&P, and from the Dow, and see if you can, pick out, maybe it'll ring a bell, scan it down and see what you see around 4%, and see if the, name rings a bell. But so if you put stock winners, if you just Google even stock winners, and for Friday, you'll find it'll take you to, I even think Yahoo Finance If you go to Yahoo Finance, you can get that. So you can see all the winners and what they gained.
Okay.
Yeah.
All right. And do you want me to call you back and let you know what it was?
Nah. No, because I'm not worried about any one-day gain. It's either a stock. I had some stocks on my list that were up over 4% for the week. Probably majority of that Friday. I don't know. Let me think. There may have been. I feel like there was one that was up significantly on Friday, but it doesn't matter because I would never, if it's not a stock, if it's a stock I already own, then I've been flagged on it and I know about it. If it isn't, it's not one that I'm going to ever add because not ever, but it takes me about 6 quarters to add a stock to my list. So, but I'd have to look at it and see. I just look at it and see what they do, and there's probably a reason for that. But just remember, I say this in my town hall meetings. John Paul Getty said, "If you can see the bandwagon, you missed it." So you've got to always be careful. What we do, as it's our human nature, is we jump on things, we buy things based on good news, and it's probably one of the worst strategies you can ever have. So, you got to be careful that it's great that a company, for instance, I had some companies on my list that were up dramatically last week, none of which, the 2 of them were, but hardly any of them were on my buy list through that period of time. So, but you can't worry about it. You got to be careful that you don't jump on good news. That's how we, when we're doing that on good news, then we have the same tendency to do it on bad news, meaning that we sell on bad news. Oh, the stock just came down, 6% today, and you get out from under it. So, my goal has always been to try to find the next bandwagon, not to jump on the bandwagon. So you've got to be very, very careful. So all my analytical work is looking for the companies I know, looking for opportunity in future gains, and for the long term. And that's kind of how that's my personal style, and that's how I think everybody should do it. But that's what I do on my website every day. And so those of you who are partners with me on the website, you see my buy list. I added a few. I think I added 4 stocks this morning to my buy list. But, know that I add some, but they're all for 8 to 10 years. And, the best thing is just a steady, disciplined approach. If you have a company that is strong fundamentally, it's a company that you like and you're buying it, you're going to do well. Let me go to Leon in Ohio. Hey, Leon. Go ahead, Leon.
Hi. Thanks for taking my call.
Sure.
I've got an interesting situation. I'm an older gentleman, about 55. Got married later. Have 4 kids, 2 to 10. Mm-hmm. I'm getting close to retirement, and I have several $100,000 in a retirement account. Mm-hmm. And I was wondering how I could best use that to get an education for my children, so they're not burdened with these loans that
yes.
I keep talking about. And yeah. I just don't know what to do with that money. It's about around $300,000. Mm-hmm. And I don't know how to actually use that money. I'm going to, end up going back to work, because, I'll have a pension, and I believe I can, live off of that. But I want to kind of live as easy as I can.
Sure.
So I'm just trying to figure out how to use that money.
Well, here's a couple things. First thing I want to tell you is what not to do. And don't get talked in if you're talking to advisors and such. Don't get talked into participating in what is called a 72T program. You may have heard of it. You may not have heard of it. 72T stands for an IRS code, a line in the IRS codes, line 72T, and it allows you to retire before you're 59 and a half, or obviously you can retire anytime you want, but it allows you to take the money out on a consistent basis before you're 59 and a half without any penalty, without 10% penalty. But the problem with the 72T program is you've got to take a significant amount of money every month, and it's based on an IRS calculation. So you'll get a range. If someone tried to talk you into that, you would get a range of, and I'm making a number up here, but you would get a range of $4,000 to $7,000 a month. And you would pick a number between there. So you would pick a number that says, well, I'm going to take $4,500. Once you do that, you can't change it for 5 years or 59 and a half, or no, 5 years, or 59 and a half. Yeah. So you can't change it. And the reason that's bad is if the market tanks and it continues to tank for 6 months, you're still taking this $4,500 and it kills accounts. So don't do that. What you need to do is when you're 59 and a half, you need to start making withdrawals from it. Now, the problem with that is you're going to pay taxes. The problem with you and doing that is you're going to be still working. So it is likely you're going to have to find out what at that time is going to be pushing you in another tax bracket. So let's say you make $100,000 a year and the next tax bracket is $134,000 a year. So you've got $34,000 that you can withdraw from your IRA, this 401k that will be an IRA. You can withdraw without pushing you into another tax bracket. You still have to pay tax on it, but it'll be at your current tax rate. And I would suggest strongly that you do that. And then you set that money over in an investment account, and you do that again the following year. And you do that and until you can, so that you can build up this college savings. Now, the other option that I really like, if this were a possibility, so you're 55 years old, let's say you retire when you're 56, and you go to work somewhere else when you're 56. And that somewhere else has a 401k plan. And that 401k plan allows, which most of them do, allow for you to roll over your other old 401k money, IRA money, or whatever you might have from a previous company into the new plan. Then that plan, the new company plan, allows you to borrow from your 401k. And you borrow from it and you pay yourself back with interest. But you borrow your 401k money. That is a great option to use that borrowed money to put into a savings until you need it to pay for college tuition. So that's a way of getting it out without paying the tax on it today. If you don't want to pay the tax on it, you can borrow it out. Here's the kicker. If you chose that strategy, understand that once you borrow the money out, you have to be with that company for the next 5 years. If there's a risk of you losing your job in the next 5 years, if it's a risk of the company closing down, or there's a risk of you quitting, then you don't want to do that, because then all that money, until it's paid back, that is, but before it's paid back or 5 years, then that money is going to be considered taxable income to you, and you'll have to pay a penalty if you did it before you were 59 and a half. So I don't know if you followed all that, but they would
basically, yeah, I did. Mm-hmm.
Yeah, that would be a great option for you if, depending on what your next company allows.
So my primary concerns there would be how long I want to stay with that company,
yes,
and whether or not it's going to be in business at least 5 years.
Yes. Or at least, 5 years, or until you get it paid back. So
okay,
we're gonna take that loan, and then you're gonna take out of your pay, as much money as you can to put in there to pay that loan back as quickly as you can.
Okay.
And that's the best option if you can do it. Okay?
All right.
Thank you.
Thank you for your time.
You're welcome. Thank you for your call, Leon. I sure appreciate that. Great question. You're listening to Financial Issues. I'm Dan Celia. The economy, helping you with your stewardship. And yes, we take a look at some political issues as well.